Okay, hello everyone. Thank you very much for showing up today. My name is Juan Ibanez. I'm a research associate at the Center for Blockchain Technologies. This is going to be an interesting session, I think, because I am not a computer scientist. My background is in law, and I have background in law and in economics, even in political science. And we're going to talk about blockchain and its impact in logistics and in accounting. With me not being a computer scientist, two things can happen. One is you may get an interesting interdisciplinary perspective and some other points of view to supplement what you already know, or you may hear me talking nonsense. And in any case, that will be useful for me if you let me know. Maybe the two things will happen. So we'll see. We'll see about that. But yeah, hopefully it will be enriching to both of us, and I'll leave my email at the end of this presentation for us to discuss this. So yeah, we're going to be talking about blockchain impact in logistics and in accounting, and this is the result of some research that I've been doing with a few colleagues, Java here, Paolo Tasca and Chris Bayer, our research associate at CBT. So yeah, this is an ongoing work, and I hope it's going to be interesting to you, as your feedback is going to be interesting to me. So just to get started, I would like, just to understand my audience, to know if you are aware of what blockchain technology is. If I asked you, would you feel comfortable explaining what blockchain technology is? That would be like a yes or no question. I don't know if you could say that in the chat, or unless Java, you're setting up a poll there.
There's no poll, so
okay.
We have
in the
one
chat.
thumbs up. We have one thumbs up. I cannot really see. Yes.
One thumbs up, one yes. If somebody, okay. Two yeses and one thumbs up. That's pretty good. Semi, okay. Feel comfortable saying no if that's also the case. Let me ask another question then. If I asked you, would you be comfortable explaining the difference between blockchain and distributed ledger technology, or DLT? Would you know the difference between those two terms?
Silence.
Okay, that we'll take that. Yeah, perfect. We'll take that as for an implicit no and an explicit no as well. Great. So actually, I think distributed ledger technology is a term that is more useful for what we're going to be discussing today. Blockchain is a type of distributed ledger technology, and these are both technologies for basically database management, database maintaining. So if you want to keep, specifically, it's a technology to maintain a shared database. So if you have a database, or you need to keep a shared record of data with another party, that makes it a shared database. You can do it in a number of ways, but simplifying it, you can, well, one of the two parties can keep it him or herself, and the other can trust the other party, or they can delegate it to an intermediary, but in that case, they need to trust the intermediary. Or they can resort to distributed ledger technology. This is a stylized explanation, but distributed ledger technology is a way in which more than one party can have a shared database without needing to trust the counterparties. Basically, what the system consists of is of the nodes, that is the computers, maintaining a copy of the database each. And in theory, they should all have the same database. If that's the case, then great. If that's not the case, there is a mechanism for them to reach a consensus on which one is the right database. Blockchain is a particular kind of distributed ledger technology. That is, blockchain does this. The nodes replicate the database and reach a consensus on what it is, but it's also a particular form of this in which the messages consist, the transactions are recorded as messages, which are packed into data packages called blocks. And blocks are appended once validated, and they are included into they are appended to a chain of blocks. And then the community basically follows the longest chain of blocks, which will tend to be the honest chain of blocks. But that's like the explanation of what blockchain is, and we only need to know what this DLT is, which is a more general category encompassing shared ledger technologies for multiple parties that don't trust each other. And this was only introduced by Bitcoin. So Bitcoin was the first example of blockchain technology, and thus a type of DLT. Now, if you, so with a few colleagues, as I said, we were looking into the impact of blockchain in logistics and in accounting. And a term kept coming up all over the place, which was triple entry accounting. So if you look this up, you'll find it all over the place. You know, if you go, I don't know, on Twitter, you'll find these challenges such as describe Bitcoin in 4 words. And people say, well, decentralized triple entry accounting. And you look up for news, you look for news and you find these news and triple entry accounting saying this is the most important invention in the last 500 years. The important innovation nobody's talking about. You can see here some companies, Legium here in the right patio, saying we are the ones to provide triple entry accounting, basically by our system. Here's another company in Forbes, they're discussing this. So it's trendy, and we started reading about this, trying to learn about the impact of blockchain in accounting. This term was key, but also there's a huge gap. The explanations are contradictory. There's not a large academic production here. It's not super clear all the time what triple entry accounting is. Sometimes people define it in different ways. So we decided to fill in that gap and conduct some research on the matter. Turns out that there were many interesting findings, including that triple entry accounting was one of the ideas that may have influenced blockchain itself. It's also one of the things enabled by a blockchain. So there's like a sort of bilateral relationship there. This has resulted in a series of papers. All of them are working papers. These papers, you can see them on screen. You can look them up if you're interested in learning more about this or giving us some feedback. So we are putting all of our findings into these papers on triple entry accounting and blockchain, and basically the general impacts in society and the economy that these can have. So back to the core of the matter, let us try to sort out what is triple entry accounting or triple entry bookkeeping. And if you look this up, you'll find probably this graph and a rather simple explanation. So imagine, and I can explain this with an example. Imagine that Alice owes Bob £100 and decides to pay Bob her debt. So she sends, say, an envelope with £100 to Bob's house. Bob receives that, and then Alice goes to her own books, her accounting, her records of how much she owes, how much she has, and she decides to write down what she just did. So she says she paid £100 to Bob. Then Bob will do a similar thing on his end. He was owed some money and he decided he received it, so he's writing that down. His debt has been paid off, so he writes down that he received £100. So as you can see, Bob and Alice in this example, they are recording the same transaction. They are actually making the same record with one difference, and it's that the record of Bob is mirroring the record of Alice. So what Alice records as an outflow, Bob records as an inflow. And they are making the effort of writing this down twice. So there's a duplication of efforts here, although it's not a huge problem right now. So you can say that this is a potential inefficiency, but this system seems to work fine so far. The problem is, let's say Bob forgets to write one of the zeros in his record, and he writes down that he was paid £10, not 100. So later on, he checks his books and sees that Alice still owes him £90 according to his records. Alice of course, disagrees with this. So they, they get in touch in communication, but they have a disagreement and they need to go back in time, basically, and checking what actually happened. So they need to go to the receipts of what happened, or may be easy to solve, may not be. This may seem like a far-fetched situation, but add many transactions in a complex economy, and this becomes very real. So one of the things that we were looking into is one use case with a large supermarket chain who was undertaking a triple entry accounting use case. And this supermarket had many suppliers, right? So the supermarket sells a lot of goods, and in order to fill its shelves, it needs transportation companies to bring the goods to the supermarket, and it needs to pay them. So so far so good. How much does the supermarket have to pay to the suppliers? Well, that is actually a bit more complicated. So turns out that you don't just pay a fixed amount to a supplier. You pay a fixed fee, but on top of that fixed fee, you pay a variable fee, which depends, and this is literally the case, on 170 variables, which is a lot. This means that you pay a fixed fee to your supplier, and then this it depends on how many kilometers your supplier has driven, how long it took the supplier to bring the goods to your supermarket, if there was a detour, if there was some sort of delay, and many other variables. Now there's another problem, and it's that supermarkets, they have a lot of income, but not a lot of profit, or not a lot of profit margins. This means that supermarkets, when they sell a lot of stuff and they buy a lot of stuff, so they receive a lot of money and expense a lot of money, but they just reap a rather small profit margin from each operation. This has consequences, and it creates a problem in that what happens if a supermarket is being ripped off by its suppliers or any other partner? The supermarket is paying a bit more than it should. Well, since it has a lot of expenses and the transactions are being repeated all the time, that little ripoff that is suffering, it can amount to a huge amount. Since the income is a lot, but the profit is rather small, being ripped off can make the supermarket's profit become a huge loss rather quickly. So supermarkets are very complicated to deal with because they want to double and triple check every payment that they need to do. In this, so imagine what happens from your point of view if you were a supplier is the following. Let's say you bring the goods to the supermarket, and you say, okay, I'm owed 2,000 pounds. I'm going to send an invoice to the supermarket to get paid. You send that, and the supermarket receives that, and that gets forwarded to, say, an accounting department, an invoicing department, a supplier department, or some specialized department, which is going to check your invoice. And they're not going to take your invoice at face value, but they are going to make their own calculations of how much they owe you. And they're going to, I'm making a stylized story here, but they're going to say, okay, you needed to drive 150 kilometers and you drove this many hours, at least in principle. And they will only, I'm admitting someone there, and they will only pay you if their calculations match exactly your invoice. If not, they will not do it because, as we know, they cannot afford the risk of being ripped off. Now, in principle, this should not be a problem. The supermarket checks and only pays when they are very sure. The problem is that they are not always very sure. And sometimes it may happen that there are discrepancies. Sometimes people make mistakes. Sometimes there is incomplete information. So what happens if you, the supplier, send an invoice for $2,000 to the supermarket, but the supermarket responds, no way, we're only, according to our calculations, we only have to pay 1,800. In that case, you will need to get in touch with the supermarket and try to sort this out. This is a process called reconciliation. And if that doesn't work, you need to go to dispute resolution. If that doesn't work, you need to go to a trial to get your money back in case you're right. And this all takes a lot of time on top of that. So there's a risk that you will not get paid what you were owed. And even if you do, you will get paid with a delay. What if you need the money? Well, if you need the money, and the supermarket is not paying for a number of months, maybe you can go to a bank and get a loan. When they ask for collateral, you say, look, I have an invoice here and I will get paid 1,800, maybe 2,000, at least 1,800. The thing is, I need to wait a few months. Can you lend me money? And they can, but then you have to pay off the debt with interest. So this will cost you. There's a more complex operation called invoice refinancing, in which you give the rights to be paid by the supermarket to the bank, and the bank will give you the money in cash right now, but they will give you less money. So let's say they give you 1,500, not 18 or 2,000. So this is a lot of trouble. You're losing money, you're wasting your time. And if this happens many times with a supermarket, one day you'll pack up your luggage and say, I don't want to do business with this supermarket anymore. It's costing me too much. And this happens. And you lose a partner, and so does the supermarket. And this is a problem. So how could you solve all of this? With a shared ledger. If you and you are the supplier and the supermarket, they have the same record of how much is owed by whom, you don't need to reconcile. You already have intrinsic reconciliation. You're both looking at the same database. So this is what is often described as triple entry accounting, having a shared ledger. This is not exactly what triple entry accounting is, but it's a part of it. Now, we already established that having a shared ledger requires trust or an intermediary or this new technology, which would be distributed ledger technology. So if you don't have that, you, the supplier, need to delegate accounting to the supermarket, which is not going to happen because you don't want to get ripped off. Or the supermarket needs to delegate it to you, which is also not going to happen because they don't trust you. Or you need to find an intermediary, which is costly, or you can find a new solution. And triple entry accounting is actually a proposal to solve this. You see, this is the typical graph of a shared ledger that you will often see if you look up triple entry accounting. So here is, for example, the white paper of a company making the exact same explanation. In fact, actually, transactions are a bit more complicated than just payments. So payments are one half of a transaction, but there's also people don't just pay just because they get something in return. So transactions are bilateral processes in which one party pays and the other gives something in return. So this would be like a more proper depiction, right? What one sees as an outflow, the other sees as an inflow, and vice versa. And if you want to make it a bit more fancy, you can look at this as like three-dimensional bookkeeping. There's just one record, but depending on who you are is how it appears in your screen. So here there's an example in which Alice sells a bicycle to Bob for $70. So she sees the record as sending $70 and getting a bicycle in return, but then Bob sees the opposite thing. But we are talking so far about a shared ledger, and triple entry bookkeeping is not exactly that. It's a specific proposal of how to build a shared record. So not all shared records would be triple entry records. Triple entry record is a particular idea, which has, say, a triple entry form. What does that mean? In order to understand that, we can go to the fathers of triple entry accounting, which are Ian Gregg and Todd Boyle. Ian Gregg is a rather well-known computer scientist, so you may have heard of him. Todd Boyle was a rather well-known accountant in the 1990s, but I'm guessing you have not heard of him. Just to spice things up, Ian Gregg has been accused of being Satoshi Nakamoto, the creator of Bitcoin. We have spoken with him. He denies it. He says he has spoken with the team that is Satoshi Nakamoto, but he's not. I'm not claiming that he is. I'm just putting this rumor here to spice things up. But yeah, Ian Grigg and Todd Boyle, they are the founders of triple entry accounting. They came up with this idea, and actually they were working in parallel, independently, not knowing of each other for about 10 years until Ian Grigg published a paper on the topic. Todd read it and said, hey, I have been working on the same thing. And they basically started collaborating and kind of merged some efforts. And let's go to this drawing is actually from Todd Boyle's website. This will be hard to find if you're looking it up because Todd Boyle kind of retired after the Iraq war. He decided he didn't want to work for money anymore and took down his website. We found the repository of the website, and he was explaining the system like this. So how can you build a shared record? He had a proposal, which was, I will set up a website, which is called a web ledger, in which everybody can have an account. So if you want to say that you are giving me $100 in order to get a bicycle in exchange, you write a message saying, Alice gives 100 pounds to Bob. Bob gives a bicycle to Alice, and you send that to the website. The website forwards that to Bob. And if Bob, let's say Bob agrees to this, he will take this and accept this offer. So he takes the draft that one party sent and posts it. Or in other words, it takes the offer from one party and accepts it. So that gets sent as a message to the system, which checks that everything is in order, checks that both parties have agreed to this, and posts and validates the transaction. So you can see this as a process of an offer, an acceptance, and a validation. 3 messages: the offer, the acceptance, the validation. Ian Grigg was working on something super similar, saying, let's have 3 signed messages. How do you know that this message came from the other party and it came like this? How do I know that this record is what I agreed to a while ago? Well, with cryptographic signatures, with digital signatures. So let's send a signature, a signed message with the offer, accept with the signed message, and validate with the signed message. There you have it, 3 signed messages forming a triple signed receipt. That's the triple entry, the 3-way record. As a matter of fact, so the proposals were slightly different, as Todd Boyle was considering a more active role for the third party. Ian Grigg, being more well-versed on cryptographic signatures, did not conceive of a larger role for the third party other than validating and timestamping the transaction and ordering and timestamping the transaction. Everything else is cryptographically signed. But the proposals were super similar. As a matter of fact, Todd Boyle did not consider this and they both independently named it triple entry accounting, which was funny. Actually, Todd Boyle did it for a different reason. So Ian Grigg did it because there were 3 messages, 3 signed messages. Those were the 3 entries. But Todd Boyle did it because those 3 messages, yes, they existed and they formed a shared record, but that was just one entry. Then entries number 2 and 3 were like private records called stubs that each party could have to have just information that only they could see. But in both cases, you needed a third party. This was, of course, until blockchain, in which the third party was replaced with the community of computers, and there was no more need to trust. So nowadays, there are a lot of companies trying to implement this model with blockchain technology. So here you can see offer, acceptance, timestamping, and ordering, signature. Finally, Grigg was doing this because he wanted to build reliable shared records. Boyle was doing this because he wanted to end redundancy and the duplication of efforts and the reconciliation. But it turns out they come up with the same solution and solving both problems, which was pretty amazing. So yeah, there's a lot, as I was saying, there was a lot of companies trying to implement this. Here there's a table with some of them. You can see Bitcoin here. Bitcoin is often described as a triple entry system, but the companies more in the space of triple entry accounting properly are the ones here in the bottom. As you can see, some are in red. It means they are deployed. The others are not deployed. So this is still an ongoing race, and there's no clear winner in the race for building the best triple entry accounting system. Now, if triple entry accounting, if Bitcoin is triple entry accounting, and does that mean that Litecoin, Dogecoin, XRP, they're triple entry systems? And no, they are not. And if you probably have never heard of this accounting platforms. Why are they building this if Bitcoin has already done it? And this boils down to the difference between bookkeeping and accounting. This is language, so it's disputable. Language is what people speak, and some people, they treat the words bookkeeping and accounting interchangeably. But it's kind of useful to make a distinction between the two. So bookkeeping is defined as record keeping. It's keeping a record of who owns what, or who has sent what, how much of what to whom. Whereas accounting, while it includes bookkeeping, or it's based upon bookkeeping, it's a bit more than that. It's like an intellectual process in which you process the records to make the information flow to parts of the firm, to shareholders, to make that information valuable and useful. So a financial report, an annual report, that's accounting, but which is based on bookkeeping, but that's not just bookkeeping. If you want to know if a company's financial situation is solid or not, you will go to the reports, not to the daily journal. So you're resorting to accounting, not to just bookkeeping. You cannot make a financial report or an annual report just by reading the Bitcoin database, right? You need an accounting software on top of that. So even if you argue that Bitcoin is a triple entry accounting system, it's a triple entry bookkeeping system, there's no accounting there. So all these companies that we were looking at a moment ago here in the bottom, they are trying to build accounting solutions on top of this triple entry bookkeeping record. And this is important. Why? I will get to that in a moment ago. But before that, let's get Bitcoin out of the way. You'll find in many places that Bitcoin is a triple entry system. And Twitter is one of them, but you can also find that in many news. You will find even in our own papers the rumor that that Bitcoin is actually inspired by Ian Grigg's work in triple entry accounting. This cannot be confirmed, of course, because we cannot talk with Satoshi Nakamoto. Of course, if Ian were Satoshi, that would make a lot of sense. But yeah, but is really Bitcoin a triple entry accounting system? And if you think about it, you'll say, okay, so Bitcoin is a system for transferring digital cash. And yeah, I can see how there are signed messages there. When I send somebody money, I am sending a message and signing it. I'm using the public key, private key pair. So there's my signature as a sender, just like the triple entry accounting model says. But the person receiving Bitcoin is not signing when they receive. They are not accepting. So what's that all about? Aren't people saying that Bitcoin is a triple entry accounting system? Where's the second signature? And where's the third signature if there's no third party to validate? The third signature is a bit more easy to understand where it is. It's in the community. The community is collectively signing off on the transaction. But where's the second signature? I don't know if you're familiar with how Bitcoin works. I'm going to give a quick explanation. I'm also not an expert. Some of you may understand this even better than myself. But basically, Bitcoin follows a model called the unspent transaction output model, or UTXO model, which is kind of like this. Say you have 100,000 Satoshis, which is a sub-unit of account within Bitcoin. You can think of this as 100,000 Bitcoin if you want. And you want to pay somebody 50,000 Bitcoin. So you might be tempted to say, I'm spending 50,000 of my 100,000. But actually, you're not doing that. You're spending all of your 100,000. Let's say 10,000 of that you spend them on transaction fees. You still have 90,000 left. You spend those entire 90,000 to produce two new outputs. One of those outputs is effectively what you want to pay, 50,000, which is transferred to a counterparty. And then the other 40,000 that are left, they get transferred back to you. That's your change. That's like the second output. So yeah, and you have done that through a signed message. So again, there's the first signature. Where's the second signature? Well, let's say now you're the counterparty and you want to spend your 50,000, but you don't want to spend your entire 50,000. You want to spend 20,000 of those 50. Once again, you need to spend the entire 50 to produce 2 new outputs plus the transaction fee. So basically, you need to send a signed message saying, hey, in the past, I have received 50,000, not 20,000, 50,000 from this person, and you are sending a message signing off on the transaction history. So the confirmation of receipt comes late, but it comes. There's like an asynchronous second signature. So there's that. And then this transaction is received by validators called miners. They put this message into a block of messages, and they have a race to solve a cryptographic puzzle. If they do it, they get the reward, the transaction fee, and a special reward. And then they broadcast this validated node appended to the chain. This is validated block appended to the chain of blocks to the community. The community will accept this because this is the longest chain. And there you have the third signature with the community signing off on the transaction as well. So you do have 3 signatures. But as we were saying, there is no accounting software on top of this, which is what these companies are trying to race to build. So you can say that Bitcoin is in a way a triple entry bookkeeping system, but there's not so much accounting there. So why is this important? What can you do with triple entry accounting? A lot of stuff, but I mean, you can make things much more efficient, and with blockchain, you can also make them efficient and secure. So going back to the supermarket example, you don't need 2 teams of people writing down in paper how many kilometers you've driven and how much time. You can just have a GPS, which is what we call an Internet of Things oracle or IoT oracle, just broadcasting this information to the blockchain. Of course, nobody must tamper with the GPS device, so that's something, a vulnerability that you need to account for. But then you both have the same shared record. You can both trust the shared record. You get rid of human mistakes. You can record the information more quickly. You don't need to hire an auditor to check that the transactions or the information that you're recording happened like the parties are saying it happened. Like one party saying it happened, you just know it did because you have 3 signed messages validating this. So you can just spend your time as an auditor trying to figure out more important stuff, more intellectual stuff, not whether the record mirrors the reality, but whether the reality is good or bad, whether the company is in a good or bad financial position. You don't need, you can look into the information that you have more deeply, not just looking at, I don't know, how much so I'm going to exaggerate again, but if you're looking at a financial report, it has aggregated information. So it has your income and your expenses and your profit. And you may look at it and say, okay, we need to cut down expenses. But if you can look at every single transaction, you can go much more precise than that and see where you are expensing too much. If you are expecting a shipment and it's not coming, you could know in real time where it is, and you can trust that information. You don't need to go into reconciliation, dispute resolution, because the reconciliation is already intrinsic. You can stop having a lot of trials for this kind of stuff and going to court. Many of the companies working on this are already starting to report benefits here. You stop having problems of human errors leading to overpayment or underpayment. You know exactly how much you need to pay. And the payment may even be triggered automatically. And if you're not underpaying, so when you have the problem of underpayment and overpayment, you get people trying to play the game of having more underpayments than overpayments, which is a bad game. And if you're famous for underpaying, that will harm your reputation and thus your credit worthiness. So it's a lot of trouble that you can solve with having a shared ledger and in the form of a triple entry system. So there's many benefits to this, and this is why companies are trying to figure this out. Now, since we have a little more time, let me tell you a few of the findings that we have regarding this technology. So we, in our research, we were trying to figure out the costs and benefits of this technology, trying to figure out where the company stands in developing this, when this technology is useful, most efficient, and where it's not. Because of course, like any other technology, it has a cost. So you need costs to be smaller than the benefits for this to be efficient. And this will depend on the market that you're in, on the circumstances that you're in. So yeah, it depends. And this is part of what we were trying to figure out. And we were building a list of companies here. There's some of the companies trying to figure this out. And we found this company, Patio. They had a list of their competitors, right? A document on their competitors. And in the field of triple entry accounting, one of them was this other company called Biller, supply chain on the blockchain. So Biller was listed as a triple entry accounting use case. And we said, okay, this is great. We have their name. Let's contact them. And we contacted the CEO of Biller to ask about Biller's costs, Biller's benefits, their numbers, whether what they were doing was good or bad. As a matter of fact, Biller is a failed project now. Unfortunately, the founder, the CEO, has passed away recently, and he took all the passwords with him, which effectively shut down the project. But we were in touch before this happened, and we are asking, yeah, what are your costs? What are your benefits? We noticed that you are building a triple entry accounting system. We are doing research on it. We would like to know this. To our surprise, they said, no, we're not. We're not building a triple entry accounting system. So we asked, what are you building then? They say, well, we are building a shared record that two parties can agree upon through signed messages, which will have all the sorts of benefits like intrinsic reconciliation and everything that we were talking about, but it's not triple entry accounting. And why is this not triple entry accounting? We asked, and they said, well, it's not that it isn't. We just have never heard of this term. That was surprising. What are you building then? What do you think it is? And they said, we are building a system which follows an accounting school from the 1980s called REA, which stands for Resources Events Agents. So we looked into this. I'm going to make a long story short here. Turns out that REA is an accounting school founded by an accountant, an American accountant called William McCarthy, who basically argued the following. You're saying, look, if you're a manager of a company, you cannot make decisions based on the records of accountants. Because yes, you see expenses this month were this high and income was this high. We need to cut down our expenses or increase our profits. But you cannot say much more than that because this is just too general a statement. You need to go more deeply into the data, more granular. But as it turns out, accountants need to do the opposite. They are taking granular information and aggregating it into, well, a smaller aggregated record, which you can read more quickly. So as it turns out, if you read an annual report, that's maybe good to understand the general financial situation of a company, but you cannot manage the company with that. You don't know where you're overspending or you are underspending and so on. For that, then you can do two things. If you're a manager, you can, well, do your work, you do your job poorly using this poor information that you have, or you can build your own information system. And that's what companies do. So in practice, departments end up having their own information systems each, which again, they are all supposed to record the same information in theory. But again, in practice, there are discrepancies, there are mistakes, which cause a lot of inefficiencies, different departments of companies managing different information. The solution to this, again, and this is what they were saying, is to have the same record for everyone. And soon they extended this accounting model to show that you could do that also for your relationship with other partners, not just departments of the same company. So this is what we call external integration as opposed to internal integration. So this is exactly the same kind of thing that we were talking about. So what in this accounting school they were doing is they were saying, okay, if you need to build a shared database, you need that database to be useful for all the departments of a company and even several companies. How do you do that? Well, that's what they were trying to figure out. And they were saying you need to build a database. You're computer science students, you probably know more about bases than myself, but basically there are many tables and you need to connect the tables. And they were saying that the map of this table should have a structure which is centered around tables of resources, of events, and agents. So resources that are being exchanged by agents in events. So this is not super important for us. This is just how the database should look like. So this is one example of how it looks like. It's very, they are very large tables, databases. There's and currently this started in 1980s, but they have been, or late 1970s, but they have kept on working in this for years. And even today, they are trying to materialize this model. You know, with what technology? With blockchain. Or more generally, distributed ledger technology. There's a huge project in Holochain called Holo REA, if you're interested. So in practice, so here's an REA record as opposed to a blockchain record. They are rather similar. And here, this is a poster in a conference about REA and blockchain. And look at this, the bottom of the poster. You have the shared transaction record, which each party sees their own way. But it's the same record that they are looking at, just through different classes. So you see, this is a very similar idea. So you can see this as the REA school is explaining how the database should look like for people to share it. Triple entry accounting is a model for how the parties can agree on the shared database. And blockchain is how you can do that, removing trust of the equation. Well, as it turns out, our research, and I'm going to be quick with this, shows that as a matter of fact, this is not a coincidence. This is probably not a coincidence, but these three ideas are historically related. So if you look up triple entry accounting, you'll find a very simple story in which some guy, some Japanese accountant came up with the model for triple entry accounting in the 1980s. In the 2000s, Ian Gregg popularized it by making it about signed receipts, but then this wasn't viable because there was no blockchain, and there was a blockchain and you didn't need to trust anymore, and boom, now you have this. In fact, this is not so. The work of this Japanese accountant is unrelated to this, and the story is more complicated. We'll skip to the end. Turns out that we were, so people are always talking about Ian Gregg's work, not about Todd Boyle's, as we were mentioning at the beginning of this presentation. Turns out that Todd Boyle was a follower of the REA school. So it's only natural that his model is similar to this accounting school, and that Ian Gregg's model is also similar to Boyle, since they work together. And the rumor is that, of course, that Bitcoin was influenced by triple entry accounting. So if this were true, which it might be, this would mean this accounting school has influenced Bitcoin and thus blockchain. So it's only natural that these technologies are similar and complementary. Part of what we're trying to do right now is to, since they're working separately, the REA accounting school is working on blockchain on one side, and the TEA triple entry accounting side is working separately. We're trying to get them to work together. I think could be very interesting for companies. And yeah, so that's one very interesting finding that we had. And we are also working in other kinds of stuff, which you may be also interested in. We were talking about the difference between blockchain and distributed ledger technology at the beginning of this session. And if you try to explain what distributed ledger technology is, you may find explanations that. So what's different between a ledger and distributed ledger technology. And the temptation is here to say that it's distributed. That's the difference between a ledger and distributed ledger technology. But I think you know this, distributed systems and distributed ledger technology, they're just not the same. Distributed systems have existed for a long time. We have the idea that people are using this graph right here to distinguish between the centralized, the decentralized, and the distributed, which is a graph for communication, but this does not match current usage of the term decentralized and distributed. And in fact, this graph right here in the middle, well, it has a center, so it's not so decentralized. Actually, the one that is decentralized is the one on the right. So we're trying to push for making language a bit more precise. This also has an impact on distinguishing what is a journal and what is a ledger. So in the field of computer science, maybe accounting vocabulary could be useful. People are saying that Bitcoin is a distributed ledger, but it could be that you could call it another sort of thing, such as distributed journal rather than a ledger. This, we won't get into this right now, but it's also another interesting thread that we're following. Just to make you aware of our research. And once again, you can find these papers delving on these matters in SSRN or archive. These are the titles of the papers. I don't know if I have made sense to you or not. If you think this is interesting, then you can read more by reading the papers. If you think this is wrong, or some of what I have said is wrong, feel free to email this to me, to us, so that we can improve our paper. We tend to acknowledge contributions, so there's that. And if you think that you should look into this more deeply to find out whether we're right or wrong, you can also read the papers. And here's my email address in case you want to write. And thank you very much for attending this session. I hope I have not bored you too much. And if you have any questions, now would be a moment to open the floor for a Q&A. You can ask in the chat if you want. I don't know, or turn on your microphones as you prefer. I'll be waiting for questions then. Thank you very much.
Thanks, Juan.
I see the claps there. Thank you for clapping.
Let's see if we've got questions.
Don't really have a question.
Yeah.
I mean, I don't really have a question, but that was a great, great talk.
Thank you. Thank you very much. I have tried to cover 3 papers which are unfinished. So even we have this a bit unorganized. So we hope to make this a bit clearer in our work. So thanks to you, everyone. And Java, anything you would like to add, since you are a co-author in this?
Yeah, I think that was really good. Thank you very much again, Juan. If we had so just to advertise a little bit on our module, we have blockchain technologies module, and in the module we had a student asking about R3 Corda, and I was saying I don't quite remember what that is, and I don't know if she is now in this room. So I said you would be in a better position to talk about enterprise blockchain technologies than me, as I'm more like a blockchain purist. For me, blockchain is should be completely distributed, decentralized. But I know you are a bit more involved in enterprise blockchain projects. So if you could just give a few words on that regard, that would be much appreciated. So including, I guess, Hyperledger as well, and also R3 Corda, if you could just explain that, that'd be amazing.
Okay. So let's see, my microphone is on, right? Yeah. So I have made a distinction between blockchain and distributed ledger technology, like that's the real thing. But in fact, it's all disputed. Of course, I think we've gone to a definition that is rather consensus, but the consensus is not full. And many would argue that there is no such thing as distributed ledger technology. There's only blockchain, and blockchain is even only proof of work, right? So it really depends on your semantics. Now, that said, yes, blockchain technology, and as it was originally conceived, is designed at least to be decentralized, whereas not all distributed ledger, not all examples of distributed ledger technologies are so. And R3 Corda and private permission blockchains, they have some degree of centralization, even though the centralization is not full, in the sense that they are still designed for parties that don't trust each other to keep a shared database. That's why I'm focusing more on distributed ledger technology than on blockchain, because we can agree that this is a technology for maintaining a shared database without so much trust, as long as you trust the mechanism. Whether there's a chain of blocks, whether this is blockchain or not, that that exceeds us right now. And R3 Corda, so Corda was a consortium of banks. Now it's a consortium of many institutions. They decided to build their own system, including Ian Grigg, the father of triple entry accounting, among its developers. And so it's really inspired personally by triple entry accounting, and it follows the triple entry model. But there is no blockchain there, in the sense that there's no chain of blocks. They are maintaining a very triple way of proceeding, in which only the two parties to a transaction really see the transaction, and they work with signed messages. But there is distributed ledger that is maintained by replication and consensus. So there's that. Now, yeah, Ian Grigg is no longer involved in R3 Corda, so and maybe the project has been steered a little bit further away from this position, but it still maintains a triple entry accounting flavor, let's say. And so going back more to the industry side of things, and Joe, you were asking how what's this thing of enterprise blockchains, how they work. Bitcoin and blockchain, they are designed for parties that don't know each other. They are anonymous, and they just want to transfer money. But sometimes you want to build more complex transactions, and you want to know your counterparty. So anonymity is not a requisite. And you also don't need this system to be open to the entire public. You just need to be open to a rather close circle of parties, such as the consortium of banks that was a part of R3 when it was created. So Bitcoin would not be the best model for them to go, because they have different necessities. So which way you're going to go, if you're going to go through a public blockchain or to a private distributed ledger technology system, it depends really on what you're trying to achieve, what your needs are. But there's a common thread to this all, which would be that if you are able to maintain a shared database without trust in anything but the mechanism, you can create large efficiency effects and save a lot of money, or in other words, create a lot of value. This is a common thread to Bitcoin and Corda, to Hyperledger, and to most of the blockchains and distributed ledger DLTs out there. So this is something that you want to be looking at. It's not just a system for money. It's a system for making things more efficient. I don't know if this helps a little bit. We also did not have so much time. Is there anything else we could discuss on that note?
I think that was good. So just to sum up, what you're saying, correct me if I'm wrong. Enterprise blockchain projects focus much more on efficiency, record keeping, whereas public blockchains, they focus more on trustlessness. Is that correct? Is that what you're saying?
Yeah, that's one way to put it. Certainly. It depends on what you're trying to achieve. So on that note, these enterprise blockchains, they're often focused on improving the flow of information, including, of course, the flow of money, invoicing, and of goods in supply chains, or which are a closed chain of providers, all in all. When you're trying to set up a global anonymous payment system, you're more focused in trustlessness than on the efficiency effects within a particular stream of production. So yeah, that would be correct.
Thanks. Do you have more questions?
Just going to check the chat here. Nothing else.
Right. So with that, I think I'm gonna stop the recording, but we can stay here a little bit, I guess, until 6 p.m. as scheduled.